lower rates. It might take longer than you want, but it's going to get there. So I think we are in a Fed rate cutting cycle, even though, my own personal belief is that inflation will prove to be sticky in the next 18 to 24 months. And, if you don't own hard assets like gold, Bitcoin, US, whatever stocks in the US are doing well, you're going to feel the pinch of higher inflation.
The fourth quarter of what may be the most explosive phase of the current cryptocurrency bull cycle is almost approaching. The Federal Reserve is leaning in the direction of easing. Liquidity is starting to flow back into riskier assets, and political pressure on monetary policy is intensifying. This arrangement is recognizable to experienced investors. Every bull run starts with rumors of rate reduction, intensifies as policy is loosened, and concludes with a frenetic surge of conjecture. However, the scope is greater, the setting is more striking, and the possible rewards are more astounding than in the past. The co-founder of BitMEX and current CIO of Maelstrom, Arthur Hayes, believes that most investors would undervalue the opportunities that will arise in the upcoming months. Hayes' argument is straightforward but effective. Only once in a generation will there be an upside due to the Trump administration's push to flood the system with liquidity. He contends that the true fireworks are still to come and that we are currently in the middle of the bull market rather than its end. His assertion is supported by historical precedents. The Fed has historically been relied upon by U.S. presidents to boost the economy. Whether it was Richard Nixon arm-twisting Arthur Burns 10 years later or Lyndon B. Johnson harassing Fed head William McShenny Martin in the 1960s, Trump is no different today. The process of generating credit is already underway. From easing restrictions on commercial banks like Wells Fargo to deals involving sovereign wealth funds, and as soon as those dominoes fall, fresh capital will pour into tangible assets. According to Hayes, Bitcoin has the potential to be the largest beneficiary. Hayes doesn't stop there, though. He believes that a large portion of the cryptocurrency ecosystem will be affected by this liquidity cycle, leading to asymmetric rewards in companies with true product market fit. He contends that although Bitcoin will profit from protocols that already serve thousands of users, generate billions of dollars in revenue annually, and distribute earnings to token holders could enjoy disproportionate increases. According to Hayes, this is where people make their fortunes not by following trends, but by focusing on projects that have long-term structural viability. His research provides a roadmap and a caution for investors looking to capitalize on the next phase of exponential development. You will lose out on possibilities that could change your life if you ignore the basics. We also dissect Hayes' most recent predictions on rate reductions, stablecoins, altcoin protocols, and his belief that the crypto bull market is just getting started in today's video. Please remember to hit the like button, subscribe to the channel, and stay tuned for more in-depth insights like this one. What follows is something you won't want to miss. Thank you, and have fun with the video.
I think right now, I haven't looked this morning at where the 2 years trading, 2-year treasury note. I believe it's off something like 50 or 60 basis points over the last sort of week and a half, 2 weeks after the non-farm payroll print, the negative revision to jobs data in the US. I didn't check what PPI came in overnight, or CPI came in overnight, but I guess PPI was lower than expected 2 days ago. And obviously we had Powell pivoting at Jackson Hole, basically opening the door for rate cuts. And so I think that it's probably going to be a 50 basis point cut at the Fed. I think Trump and Bessent want more. And obviously that's why Trump is putting all the pressure on Fed Governor Cook. There's rumors that, I can't pronounce her name correctly, Kugel, however you pronounce that name. I saw a rumor somewhere floating around that, maybe she had some issues with her own, mortgage applications and, being a little bit more, I guess, street smart, she decided to just resign before Trump and the DOJ put the screws on her. And so I think that one way or another, just like every other president in U.S. history, the president will get the monetary policy he desires. You can take a look at Lyndon B. Johnson back in the 60s and Fed Governor Martin. Supposedly, Johnson invited Martin over to his house in Texas and physically assaulted him to get him to reduce rates. You had Nixon and Arthur Burns, Nixon putting a full court press with Treasury Secretary Connolly and others in his cabinet administration to make sure rates were lowered. And obviously, you have President Trump brow bashing Jerome Powell. And, just like every other Fed governor, Jerome Powell will provide the monetary policy that the politicians want, which means lower rates. It might take longer than you want, but it's going to get there. So I think we are in a Fed rate cutting cycle, even though, my own personal belief is that inflation will prove to be sticky in the next 18 to 24 months. And, if you don't own hard assets like gold, Bitcoin, US, whatever stocks in the US are doing well, you're going to feel the pinch of higher inflation. It doesn't really matter at the end of the day, right? The Besson and Trump need money to be printed to fund their agenda. And so the Fed's going to cut rates. There's going to be, maybe it's not direct QE, but there'll be different ways in which money is printed. Maybe it's through the mortgage market. Maybe it's through the banks lending. Maybe it's through these sovereign wealth fund deals that Trump is doing with other nations. Maybe it's through the something like $100 billion or however much there was allocated to the Department of Defense as equity to then leverage to then buy stakes in resource companies like MP Materials to help with rare earths, whatever. There's so many ways in which they can provide credit to the system. And yes, this credit will positively affect some particular sectors more than others. But the best thing about Bitcoin is that we don't care where the money is going. We know that as there's more dollars, yuan, euro, yen in the world, that currency is being debased, and this asset that we own that is a fixed supply is going to go up asymptotically. I think we're starting to get to the real meat of the cycle, middle of the cycle, because if you think about, Trump's a new president, obviously it's a second term after the Biden administration, and his first term, he's a very populist president. He did the biggest sort of handout to American people since Andrew Jackson with or probably LBJ with sort of the COVID stimulus checks, right? That's not a very traditional Republican sort of measure to basically say, let's just hand out money to people, make sure that they stop bitching while we lock them in their house for the flu. And so when that happened, he is, had bona fide credentials as a person he wants to win elections. He doesn't have ideology behind it. So winning elections means providing free shit to people. He provided the free shit during COVID. He provided the free shit in 2017 with one of the largest tax cuts ever in American history. And he's going to provide more free shit. Otherwise, him and his, Trumpian Republicans are going to get voted out of office in 2026 and then in 2028 in the presidential election. So I think he knows exactly what he needs to do, which is provide free shit and print money. And that's what he's going to do. And now, obviously, the Fed and certain individuals within sort of the bureaucracy that is the American government have been sort of stymieing his efforts. But, domino after domino is being knocked down. And, by, middle of next year, it's going to be full steam ahead in terms of the Fed's on board, no more Powell. Maybe he's got 4 out of 7 Fed governors, and he can do some other funky things with the interest on reserves or the discount window. And you have Besson doing these sovereign wealth fund deals. You have possibly Fannie and Freddie ending conservatorship, and now they can lever their balance sheets and add about $4 to $5 trillion into the mortgage markets, allowing people to re-leverage on their houses. So yes, if the consumer runs out of cash, what does the American consumer do when they don't have money? They borrow it. And so if I reduce the cost of money, then you can borrow more. And so I think that's why the price of money in this instance matters. I'm more of a quantity of money guy, but I can see that, you can say the American consumer is tapped out, the housing market's, a bit overbought. Well, if I cut rates from 4.5 to 2, well, then you're going to take more leverage and buy more stocks and, max out that credit card and buy a new car and take out a home equity loan. So I think that's, a very short-sighted sort of explanation if you sort of believe that the Fed's going to start cutting rates and Trump is going to unlock all this liquidity on Fed balance sheets, the mortgage market. And, another thing that people are not really paying attention to is Wells Fargo has just been paroled out of jail. They were not allowed to increase their balance sheet for many years after the whole fiasco the criminal sort of customer shit that they did back. I don't remember exactly what it was, but I think in middle of June or early July of this year, they were finally allowed to increase their balance sheet. There's a very famous macro analyst, Zoltan Pazar, who estimates that they have about $450 to $500 billion of capacity in the balance sheet to buy treasuries and other debt securities now that they can grow their asset base. And so you have another liquidity engine in the commercial banking system in the United States. So I don't really care a fuck about the real economy. All I care about is the credit, and the credit's going to flow, and it's going to flow into Bitcoin.
Despite the Federal Reserve's rhetoric about independence, Hayes reminds us that politics nearly always prevails in the end. As early as this cycle, he anticipates a 50 basis point rate drop, with more to come. He is more concerned with the amount of liquidity that cuts release than with whether they occur. The same thing happens whether it's through the Fed's balance sheet, mortgage markets, transactions involving sovereign wealth funds, or commercial bank lending. Increase of credit. Additionally, Bitcoin and other assets with a fixed supply go upward when credit flows, as history has demonstrated. Hayes is unambiguous. Where the fresh money comes from first is irrelevant to him. It eventually makes its way into Bitcoin and cryptocurrency, whether it is through defense contractors, real estate, or sovereign wealth transactions. His second forecast enters the picture at this point: the emergence of stablecoins as a new tool for the Treasury. According to Hayes, dollar-pegged stablecoins have the potential to be a key component of U.S. monetary policy in both global finance and crypto, in order to assure demand for its debt and maintain dollar dominance. Washington might direct offshore funds into reliable coin issuers who subsequently purchase U.S. treasuries. This is more than just a sideshow for crypto. It serves as the cornerstone of the following stage of development. In light of the possibility of trillions of dollars in stablecoin deposits moving between on-chain protocols, Hayes believes DeFi initiatives like Athena, Ethereum, and Hyperliquid are poised for exponential growth.
I mean, I don't have the specific ratio, but in the presentation that I gave, I assumed that there was about 10 trillion of stablecoin deposits that would percolate around the markets. The protocols that I was shilling, Athena, I said it would 51x, basically based on people searching for higher yields in the treasury yield, going and using their synthetic dollar and the way that they're using the basis trade within Bitcoin to generate that yield. I think about a 34x improvement on EtherFi, as people now can spend the stable coins using their offline payment services and doing the sort of like banking services that EtherFi offers. And then Hyperliquid is something about 120 or 130x uplift, because it's going to become the largest exchange of any type globally, now that you have all these people with stable coins who now want to trade on chain. Why do they want to trade on chain? Because they can. It's easy, high leverage, offers the type of products that they're interested in. So that's sort of where I want to focus in terms of like, obviously Bitcoin's going to do well. I don't know what that number is, but it'll be less than those in terms of the uplift. But sort of the riskier parts of the curve that'll benefit from this stablecoin adoption, I think, are these high cash flow generating DeFi projects. And the great thing about the zeitgeist now and sort of the investment community in the crypto space is that investors have punished projects that either A, never made any money, or B, made money but didn't give it to the token holders. And so if you're a project that is not buying back your token, is not giving back emissions to stakers, we as the crypto retail investor, or even some institutional investors, we don't want to touch it. I don't give a fuck if Sequoia and A16Z is on your cap table. Go fuck yourself. Where's my money? And so I think we're finally getting around to that ethos, and these projects that are going to do well are going to be paying us as the token holders for making them successful.
Right. Makes a lot of sense. You also said that you think stablecoins can make the Fed irrelevant. Can you elaborate a bit more on that?
So why does the Fed relevant? Because they set short-term rates. So they set the effective Fed funds rate. They have a band. They administer the interest on reserves, which is usually at the lower end of Fed funds. They also set the reverse repo rate, and which basically is at the high end of the Fed funds range. And if I'm a Treasury secretary and I'm issuing debt to some private institution who's a profit maximizing institution, well, if the Fed is offering a higher rate than what I am as the Treasury on a T-bill, then I'm just going to stick my money in the reverse repo with like a money market fund. Or if I'm a bank, I'm just going to lend it to the Fed at the interest on reserve. So I effectively, as a Treasury, cannot issue debt below where the Fed has the lower bound of the Fed funds rate. Now, if I have a stablecoin issuer who by law can only either A, put your money in the bank, which yields you almost nothing because too big to fail banks don't need deposits, they have enough, or you can buy a Treasury bill. You can't buy anything else. You can't put it in reverse repo. Can't buy any other newfangled securities. I've regulated you by law. These are the only two things you can do. Well, now, I can set the short-term rate wherever I want, because the marginal capital is not coming from money market funds. The marginal capital is coming from stablecoin issuers, and they want to earn an interest margin, a yield on all these dollars that they have. And so they'll accept whatever yield I give them as Secretary of Business. So if I think that the economy needs a 2% rate, okay, well, I'll sell T-bills at 2%. And there will be this effective Fed funds rate, assuming if I can't control the Fed governors. But in reality, the market's going to trade down at whatever 100 basis points below or whatever the number is. And so because these stable coins are regulated into buying the thing that I'm selling, I can sell it to you whatever price I want. And so another trick that they can employ to essentially neuter the Fed unless the Fed plays along and does what they want. I think the commercial banking system will become irrelevant unless one or two of them adopt stable coins, right? And this is why the whole fight about paying interest on them is a big thing. Because if I can easily pay interest as an issuer, why would I want a JP Morgan account? JP Morgan, I don't know what it pays, like 1.5%, 2% or something like that. I don't know. I don't have enough accounts, but I think that's around about the rate that you get as a depositor, JP or Citi or Wells Fargo, one of these large, too big to fail banks. But Fed funds is 4.25 to 4.5%, right? Money market fund yields much higher than that. And so the banks either have to raise their rates to match where the stablecoin is, because now I can literally, with a click of two buttons, move my money. It's all digital money. You have a digital bank run into stablecoins, or I have to raise my rates and reduce my profitability. Now, the best thing about a stablecoin issuer is that they don't have hundreds of thousands of useless employees doing all manner of bullshit, right? Yeah. Compliance is automated. KYC is automated. There is none of this legacy technology from the early 1990s percolating throughout your tech stack, which is a large bank. You don't have a bunch of fucking useless managing directors making $1 to $10 million a year scattered around your organization doing fuck all, right? So Tether is the most profitable bank in human history, making something, I don't know what the per employee numbers. I had an essay about it, but it's in the hundreds of millions, I think, per employee. I think something like 100 employees. So, this is what a bank should be doing. I'm going to take your money and I'm going to pay you an interest rate on it. Then you can take this piece of perfected collateral and you can take it around the default Lego system and re-leverage it. You can trade with it. You can earn more yield with it if you want. But me as a bank, I just do something very simple. I just take your money and I let you send it from A to B very, very safely. That's what banks should do. They should be doing also the bullshit that we allow these banks to do in TradFi. And I think I can't wait for them all to be zeros. Currency debasement ever, right? Okay, yes, the S&P 500 is up in dollar terms, but deflate that by gold since 2009. The S&P has not recovered its gold price from 2008. Deflate the housing market by gold again, and not anywhere close to where it was. Tech stocks are probably one of the only things that have big US tech is probably one of the only things that's done well, deflated by gold. If you deflate things by Bitcoin, it's not you can't even see it on the chart. It's just so ridiculous about how well Bitcoin has performed. So, I got asked this question, like, why is there a difference between TradFi and crypto? There's not. Actually, when you talk to a TradFi person and sort of really get down to what they believe, what do they believe? They believe the same things that we believe. They believe that when something happens, the Fed, the Treasury, the BOJ, the ECB, the PBOC, the SEC.
Practically speaking, this means that while the upcoming liquidity wave might boost Bitcoin, the systems designed to intercept and recycle steady coin flows are probably going to yield the most spectacular profits. According to Hayes, cryptocurrency investors have improved their discipline since the previous cycle. Projects that don't make money or disperse it are now penalized. Only protocols that distribute earnings to token owners through buybacks, staking rewards, or emissions will prosper in this setting. His argument revolves around names like Hyperliquid, which is already becoming recognized as a decentralized exchange that may pose a threat to Binance. These initiatives have the ability to generate multiples that would make even Bitcoin's surge seem manageable given their enormous growth potential, solid fundamentals, and favorable macro environment. Nonetheless, Hayes acknowledges the hazards. Changes in investor mood, regulatory conflicts, and token unlocks can all alter the course. However, his larger claim is that the magnitude of global liquidity generation dwarfs these threats. Deflation, debt, and geopolitical pressures are the cornerstones facing governments everywhere. Additionally, history indicates that they will all aim for the printing press, which is the same lever. Stimulus is becoming inescapable from Beijing to Brussels to Washington. The fixed supply assets and high-yield DeFi procedures of cryptocurrency appear to be the perfect escape route in a world where every government is compelled to devalue its currency in order to survive. The ramifications are astounding. If Hayes is correct, we are in the early phases of a liquidity-driven rally that may go until 2026 and beyond, rather than the end of a weary bull cycle. Bitcoin at $150,000 or $200,000 might no longer be a wild forecast, but rather a cautious starting point. Real revenue-generating altcoins have the potential to multiply dozens or even hundreds of times. Additionally, stablecoins once written off as uninteresting have the potential to subtly support global finance while also boosting cryptocurrency markets. What does that mean for us as investors? Then, although the road ahead is uncertain, there are plenty of chances for those who act quickly. Hayes' study highlights a straightforward reality. Cryptocurrency is still the purest form of liquidity, which is destiny. The reasoning is strong, whether or not you agree with his precise figures. Crypto wins when governments print money. Tell us what you think of Hayes' predictions in the comments section below. Do you believe that the Treasury's hidden weapon is stablecoins? Or will Bitcoin continue to be the most secure option? If this analysis was useful to you, please remember to hit the like button and subscribe to the channel. Thank you for watching, and check back soon for more in-depth analyses of the factors influencing finance's future.